Hello, ladies and gentlemen. Welcome back. This is Christopher Aaron. This is the iGold Advisor channel. It will be May 5th, 2022 by the time you see this. Something happened today that we have not seen in almost a quarter of a century. Do you know what I'm talking about? It is the half of a percentage point increase in the interest rate by the Federal Reserve at one fell swoop, one meeting today. So two normal hikes were condensed into one giant hike today for the first time since the NASDAQ bubble in very early 2000. So anytime something like that happens, that doesn't regularly happen for a couple of decades, I think we should pay attention. So what I want to do in this broadcast is talk about what the creature is up to. What is the creature doing? What creature am I talking about? None other than the creature from Jekyll Island, Georgia. If you don't know what I'm talking about, no, I'm not selling this book, but I am highly recommending it to anyone who wants to understand the inner workings of the central banking system, the Federal Reserve here in the United States, the other central banks in major economies around the world, and what the true motive is behind the workings of these banks. You know, because they come out on television and they talk about their officially given mandate of price stability and maximum employment, a dual mandate. But when you really start to dig behind the scenes and look at the history, the founding of this institution, not just this one, but the several other central banks that existed before this third version in the United States. There were two other central banks that failed before this one. You look at the founding of those, the other central banks around the world, and you realize the real motive for central banking is to protect the banking cartel, the banking system, and to siphon wealth from the general population to the upper echelons of the banking system. So, once again, strong recommendation to take a moment, read this book, highlight it, underline it. It'll totally, for me back in 2008, when I read this for the first time, this is when I had my aha moment. I was getting close to my aha moment for about a year or two before that. I was kind of connecting the dots, and something didn't really feel right with the housing bubble. But it wasn't until I really dove into the Federal Reserve's working that things really started to click for me. Now, let's look at one little snippet here from this book. By making it appear to be a problem of the national economy rather than of private banking practice, the door could be opened for the use of tax money rather than their own funds for paying off the losses. So this is the modus operandi of the creature from Jekyll Island, is anytime profits are going well in the banking system, they keep them. But anytime the banks suffer losses, they try to dish it off to the taxpayer through either direct taxation or inflation to bail out the banks. And I happen to think that there's a more nefarious reason ultimately behind the practicing of the central banks, and that has to do with the attempts to limit the potential of humanity as a whole, to siphon off wealth from humanity, to keep people, quote unquote, enslaved. The goal of that, however, is not the same as the implementation of it. And ultimately, we do have the power to throw the creature back into the abyss where it belongs. And that is one of the things that we are doing here by our very actions. So, in this update, we will look at the US dollar and the Federal Reserve. Now, the challenge is, if it were as simple as just reading The Creature from Jekyll Island and saying, okay, now I understand the history of fiat currencies, I understand the workings of the siphoning of wealth toward the elites of the banking system, then it would be a very easy trade. Then the precious metals would only move higher day after day, year after year, month after month, as they continue to debase the currency. But the markets don't work that way, and there are many other trends at work at the same time, counter trends, psychology shifts. And so I learned very early in my career that even though it's really important to understand the workings, it's not enough. We have to pay attention to the actual charts, the actual markets themselves. So let's take a look at all this and more. Thank you once again for being here. Please make sure to hit the red subscribe button before we go any further so that you'll be notified when these videos come out. And also when you're there, make sure to hit the bell icon. That's the actual notification icon. If you haven't noticed, I can't post videos every single week here, so make sure to follow our Twitter account at iGlobalGold so that sometimes you'll see quicker updates when I don't have a chance to post a video. Legal disclaimer. Okay, so here's the man himself, Jerome Powell, at today's news conference. They were back in person. That was nice to see that those virtual conferences are over. For the record, I actually don't think that Jerome Powell is such of a bad guy, to be honest with you. I think he's actually trying his best given a rather poorly stacked deck of cards that he has. I think he's generally well-meaning, but he's inherited the realms of a corrupt institution and a system. That's at least my read from him. When I watch his body language and study his facial features and the tone of his language, I like to think I'm able to do that to a decent extent, is to read people's body language in that kind of way. I don't get the look of an evil person, but I think it's the larger institution. It's really the controlling powers behind him. You know, it's the heads of the large multinational banks and then the sovereign wealth that exists even behind that, which is telling him what to do. And so he's really just kind of a puppet at this point. So I want to show you what I saw from this meeting. As I said, it was the first time in a quarter of a century almost that we had this 0.5 point interest rate hike in one meeting. Here were my takeaways from watching the entire thing. He started off by addressing the American population very directly. He looked into the camera, said, I want to talk directly to the American people. He made it seem as if he was really concerned. Is he himself concerned? Maybe, maybe not. I think the jury is still out. As I said earlier, I don't think he's entirely corrupt himself, but I think he's been given a script. He's told to say things like this as inflation is running at 40-year highs. And then he is told to blame, which is what he did, supply and demand imbalances, coronavirus-related issues, the war in Ukraine. And you want to know the one thing he did not mention? Monetary policy. So the source of all inflation, monetary policy, the printing or electronic creation of U.S. dollars, is the one thing he didn't mention. So clearly there is a policy here designed to try to pull the wool over people's eyes. And I do think he is complicit in that part of it. So I'm not saying he's totally off the hook here. No mention of monetary policy, blaming all these other things, but kind of talking very directly to the American population. As I said, this was the first 0.5 point interest rate hike since May of 2000. What's going on here? Well, of course, 40-year high inflation deserves something. At least they're doing something now. I mean, the official rates of inflation are above 7%, but those are the official rates. We all know for most of the things that we need, because in those official CPI rates, they are subtracting food and energy, and they have changed the way that they calculate the CPI. They do what's called hedonic adjustments, which means if the price of a car goes up year after year, they say, well, it didn't really go up because the car has gotten more luxurious year over year. So it's actually the same price, even though it costs you more to get from point A to point B. Hedonic adjustments, they do all sorts of substitutions. They say if the price of bread goes up by 20%, and so people are not going to buy bread, instead they buy rice, which is the same price as it was last month, they say the price didn't really go up because people would make substitutions. But that doesn't address the issue, which is the price of bread went higher, and people still do need to buy bread sometimes. Jerome Powell. Anyway, CPI itself is bogus, as I was trying to say. But even if you take the official figures at 7.5%, we are at 40-year highs. So they're taking drastic measures here. And I would say the fact that they're taking drastic measures means they are behind the curve. They're behind this thing. They're scared at this point. I mean, if we just went back 45 days, they hadn't hiked at all. Then they hike one time at the previous meeting in March, and now at this meeting, 2 hikes in a row. I don't know. They're certainly not as on top of things as they try to make it out to be. What else? He said, we expect inflation to return to 2%, yet he gave no timeline whatsoever. So as in previous meetings, he would make hints at, we expect inflation to come back to 2% in the third quarter of this year. Then they pushed it back to the fourth quarter. Then they said next year. Now, no timeline given at all. I mean, eventually Jerome Powell, we're all going to be dead. So is inflation going to be below 2% while we're all still on this planet? I don't know. Very strange language here that they're giving. Last, they did mention the balance sheet reduction, which is expected to begin in June at $47.5 billion per month. Now, this is different from the interest rate hikes. This is actually letting some of the Treasury bonds mature on the balance sheet and not reinvesting any of the principal to allow that balance sheet to actually reduce. And this figure, 47.5, starting in June, will be up to 70 by September. Now, it's interesting. I mean, if they're quasi in a panic state here, having to hike 2 times at this meeting, one would think that they would be taking other measures already. You would think that this balance sheet reduction would already be implemented, but it is not. Look at the Fed's balance sheet here over the last 15 years. Here we are. They haven't started reducing at all. In fact, this entire time that they've been saying, yeah, the inflation's bad, it's getting worse, we're going to do something about it, they were still printing all this money, you can see here. And just remember, for reference, I always like to make this point, it took from the founding of the creature, as we said, the creature from Jekyll Island, G. Edward Griffin, it took from the founding in 1913 through 2008 for this graph to get to what? $1 trillion printed on their balance sheet. And from 2008 through now, it's gone from 1 to 9. So if you were to extend this all the way back, by 95 years to the founding, this chart would look like one of those hockey stick charts. It would look like something that's gone relatively flat for almost 100 years and now is almost moving vertically. Furthermore, look at what happened the last time. Remember the last taper that they tried to do in 2017? Look at how successful that they were. They tapered for about a year, 15 months. They reduced the balance sheet by about $400 billion, a small fraction of what they had printed here over the previous 5 years. A little reduction. Markets panicked. We can't do this anymore. Hit the abort button. Boom. Keep printing, right? I mean, so do you really think they're going to, make a notable reduction this time? No way. It's a facade. It's a song and dance to try to influence psychology, which is not a poor. It is not a poor strategy, actually, by the Fed to try to influence psychology, because much of the actual phenomenon of rising prices, once the money has already been printed, which it has, if you think about it, if they just printed $9 trillion and kept it under a mattress, it wouldn't cause any real inflation in everyday goods and services. But what happens is when the psychology of the average person changes, that's when they're really in trouble. That's when Pandora is like way out of the box, and in another state or another time zone and not coming back anytime soon. So they try to influence inflation. They try to talk it down through these psychology types of games, really. And as I said, it's actually a smart strategy from their standpoint. Of course, it's deceitful to the rest of us. So that is what they discussed today. The 0.5 percentage point rate hike is the key thing. First time since May 2000. Keep that in mind. Let's look at the response here from gold today first. This is almost getting, it's getting annoyingly laughable how often we are seeing the precious metals sell off in the 2 or 3 weeks prior to these rate hikes. And then there's the rate hike, and that pretty much marks the bottom. And then, boom, precious metals shoot higher again. And then we look at silver, basically similar kind of price action. Now, I'm going to talk about this a little bit more in the remainder of the video, but it doesn't look like silver is out of the woods yet. Silver could be in for a bit more trouble here throughout the remainder of this year. It really depends on what happens here as far as follow-through for this type of move. If we can see some good follow-through Thursday, Friday, and especially after the pause of the weekend, Monday into next week, if we can see follow-through on this move, I think silver may have established an important low here. But I am not convinced yet of that. And the reason is something we're going to talk about in just a moment. And it has to do with what's going on in the U.S. dollar. Back to my point, though, over the short run, we continue to see traders basically selling their precious metals every single time. This has been going on since 2015. It's really annoying, actually. 2015, selling before the rate hike, and then in 2015, the actual first rate hike in almost a decade marked the exact bottom. And so here we had seen selling in gold and silver. Let's switch back to the gold chart. We had seen selling in gold and silver for the last 2.5 weeks, pretty much in a straight line lower. Boom, they hike. Finally, we're moving up again. It's just, I kind of want to sit and shake these, whoever's sitting at their desk selling gold, a week before the Fed hike. I want to kind of slap them a little bit and say, do you not see this pattern here that's setting up? Silver too. So here's going to be the challenging part, right? We talked about how in my own education as an investor going back 2007, 2008, when I started to learn about the Federal Reserve, I was like, this is great. Gold was pushing all-time highs. Silver was breaking out above $15 an ounce. In 2007, there was a growing awareness of the problems of inflation, commodities, oil prices were at all-time high. I said, great. I understand a theme. I was in my 20s at the time. I said, I understand something. I'm going to invest based on it. I had a few bucks in my bank account. I said, I'm going to select some gold and silver miners, and I'm going to ride this wave higher. What happened next? The crash of 2008. Everything tanked. Not only did everything tank, but the gold miners fell worse than the regular economy, than the regular stock market, despite gold performing better than the regular stock market. Silver got clobbered in the deflation. A lot of the gold and silver miners were down. I kid you not. You think you've experienced some volatility here over the last few months with some of these miners being up or down 30%, 40%. 2008, the gold mining sector, most of the junior miners fell by 98% in 4.5 months. Most of the junior miners. Most of the senior miners fell by about 85% in 4.5 months. I'm not joking. Go pull up the charts. Go look at wheat and precious metals back in the crash of 2008. It went from 20 down to 275. So what we've seen thus far is nothing compared to the volatility of 2008. That is when I said, okay, I can understand the fundamentals. That's all great, but the market can move against me despite my understanding of the fundamentals. And I can lose real money despite the understanding of the fundamentals. So therefore, what is the point of only understanding the fundamentals? It's not enough. It's only half of the equation. We must pay attention to the actual charts. And here we are at the charts. Despite the 40-year high inflation here in the United States, which is certainly due to a debasement in the US dollar, we are seeing the US dollar break out, or the converse of that is the euro breaking down versus the US dollar. And this is it. This is the sum of the available information on currencies as far as when they were freely trading. Remember, currencies were not freely trading until 1971, which is when the Bretton Woods Accord was severed by Nixon. And of course, his hand was forced by the inflation that came during the Vietnam War and the guns and butter era, and France calling in their US dollars for all the gold being shipped overseas. So it wasn't entirely Nixon's fault, but he was the one that had to push the button and say, we're severing the link between the US dollar and gold, and then all the currencies were then allowed to freely float versus one another. That goes back to 1971. So we're looking at basically the entire sum here of the euro versus the US dollar. And of course, before the actual implementation of the euro in 1999 through 2002, we're looking at the Deutschmark superimposed over that. And Germany is still approximately 30% of the entire European Union economy. So it really makes sense to superimpose the German currency here for the first part of this chart. You're looking at, the major industrial, major economic core of Europe, and then the entire euro after that. Important point. Generational rising trend in favor of the euro has now broken. Euro is breaking down versus the dollar, which means the dollar is breaking upward versus the euro. How does this make any sense? Number one, stop asking for things to make sense. Things don't have to make sense. Things can just be what they are. They can be entirely based on a psychological phenomenon in the market that may be totally wrong. Yet, the market is going to do what the market is going to do. Remember that phrase, the market can stay irrational longer than you can stay solvent. So, whether it's rational, what we're seeing here in the dollar versus the euro, whether it's irrational, ultimately, it really doesn't matter. What matters is what the markets are doing. And what the markets are doing right now is saying that despite the 40-year high inflation in the United States, things are actually better in the United States than in Europe. That is what this chart is saying. And we can start to take a look at reasons why. Why might that actually be true, if it is true? I'm not saying it's true, but let's imagine that it's true, that things are actually worse in Europe. There's two big things that I can think of as to why this might be true over the years ahead. One would be war. You got Russia invading Ukraine on the footsteps of other NATO countries. Rumors of other countries wanting to be involved. Weapons from other countries within Europe already being shipped into Ukraine. And for that matter, Putin, the president of Russia, coming out and saying, we are going to consider arms sent into Ukraine from other countries as an act of war. So what if he actually acts on that? What if he actually sends a missile over the border of Ukraine, let's say into Poland, at one of these arms waypoints to destroy the shipment of guns or tanks before they actually enter Ukraine? And suddenly you have war on the European continent. There is nothing more inflationary in the world than war. Trust me, I have experienced that in Afghanistan and Iraq. So that's the first big thing. Europe may or may not, but there is a chance at this point, may be on the verge of the start of a larger multi-country, multi-year war, which would negatively impact the euro and to a lesser extent the US dollar. Second big thing that I can think of, and it's sort of related, but let's go back to Germany. How much energy is Germany importing from Ukraine? Something like 30% of their energy through natural gas. That's not good. That's not sustainable. So if the economy of Germany and thereby the rest of Europe is going to take a hit because Germany was over-reliant on Russian natural gas, and suddenly they're saying we're no longer going to import Russian natural gas. Okay, but have you thought of a plan B yet? What is the plan B, Germany? You're going to start popping up nuclear power plants overnight? Probably not going to happen. So what is the alternate plan? And if there is no alternate plan, would that not take a toll, a slowdown in energy consumption maybe being necessary? Would that not take a toll on the rest of the European continent? Two very powerful reasons why we may be seeing the euro succumb to generational breakdown here versus the US dollar. On this chart alone, I want to tell you what this means. Taking the chart purely from a chart standpoint, when you see the euro breaking down like this from a 37-year rising trend, this should not be taken lightly. This is telling us, assuming that this breakdown holds, which is the bias, when you see a breakdown like this, you stick with the bias, which is that the chart is showing you something new. I mean, of course, if we see this reversed at some point next month, we say, hey, was this a big fake out? Fine, we'll take that when we get there. If that happens, the bias is that the breakdown is for real. This is what we're seeing. That happens for a reason, and that doesn't generally resolve just in a year or two or three. From this breakdown, ladies and gentlemen, we should be on the verge of years, if not decades, of weakness ahead in the euro and thereby strength in the US dollar, relatively speaking. From my read of the charts, what I expect that we will see is that a little bit of a bounce is setting up here now, maybe lasting through the mid part of 2022, maybe late 2022. A little bit of a bounce, broken almost 4-decade trend, should be retested from the lower side. This should fail. This should come back down to the next low here, next major set of lows in this region around 90 to 95 cents. We'll be discussing the specific targets in Precious Metals Intelligence as we go along. This should take the euro to below parity, basically for the first time since its introduction versus the US dollar. From there, I would expect a multi-year rally to commence to convince most people that the worst of the decline is over, which should be a failing rally and should make new significant lows, including but not limited to the all-time low back here at roughly 65 cents in 1985. And this very well may indeed make new all-time lows closer to 50 cents. We are talking well into the 2030s by the time this is all going to play out. As I said, 40-year rising trend in favor of the euro has been broken. This will not resolve. We will not know the reasons why for years to come into the future. But we can see the writing on the wall right now. If you are heavily exposed to either the euro as a currency or to deriving income from the European Union, you should be looking at this and saying it makes sense to take some defensive action here to protect against the decline in the euro. And so some of that's going to mean physical gold. Some of that is going to mean actually holding US dollars. Some of that is going to be real estate, other tangible assets that will not lose their value in the same way that the currency will here. But the euro is really, really in trouble. I'm not joking, guys. If this breakdown holds, you do not see a 4-decade trend break like this every single year. This is telling us something really, really negative is brewing, not just in Germany, not just in Ukraine, the entire European continent. Something is going on there, and we're going to witness this here throughout the remainder of this decade, well into the 2030s. So it's not only the euro that the dollar is breaking out against. It is also the Japanese yen, the second largest constituent of the dollar index, right there. And this trend actually goes back even further than the one that we were just looking at with the euro. This one goes back not 37 years, but 47 years. 47-year downward trend broken, with an embedded 38-year downward trend here shown in blue broken to the upside. Dollar breaking higher versus the Japanese yen. This is interesting. What can we think about Japan here? Well, what are the commonalities between Japan and Europe? Japan also happens to share a border with Russia. Yes, in fact, some of the islands are still in dispute between Japan and Russia. And even if we're not going to include those, they're only separated by about 26 miles of ocean. So, is the market here saying something about the safety or sovereignty of Japan? Should Russia get any funny ideas going in the other direction? Also, let's bring up this point. When is the last time that we have seen weakness both in Japan and Germany being the central focal point of the euro? When is the last time that we've seen generational weakness in both Japan and Germany? Right after World War II. So this is the last time in 80 years that we have seen this level of weakness. You're talking structural declines that have just been triggered here in both Japan, Europe, and the central focal point being Germany, right outside of Ukraine, where the actual war is going on. So we should not ignore this. Japan and Europe, both witnessing major declines against the US dollar. My read on this chart for the yen versus the dollar is that there's a bit of a back off to come first, but you do not ignore a 47-year break upward like this and think that this is going to just be over here in the next year or 2 or 3 or 5 or 10. This is something that is going to take years and possibly a decade or two to play out when you look at where this chart could eventually go based on the history of the trading here between the US dollar and the yen. So let's bring it back to talk about the precious metals. We saw the breakdown in the euro. We are seeing the breakdown in the yen, or conversely break out in the US dollar versus both of those currencies. And the thing that we have to remember is that even though all currencies are being debased just at different times, there are periods in which when you get surges in the senior reserve currency of the world at this time, which is what the charts are showing us is going to happen. There are periods of time where you get surges in the senior currency when that is going to impact the precious metals negatively, despite the 40-year high inflation. There is a reaction amongst traders to when we see the US dollar surging. We saw this in 2008, where when you see the US dollar surging versus the euro in a flight to quote-unquote safety, or sort of a Pavlovian fear reaction, that this can exert negative pressure on the precious metals and especially silver. So the weakness that we've seen in silver here over the last couple weeks has coincided exactly with these breakouts in the US dollar versus these two largest currencies outside of the US dollar. So I think that if we are going to see some weakness here over the months ahead, it is going to be because these continuation moves higher in the US dollar are still ahead of us. And in the worst of those moves higher, you can see the precious metals really take a beating. When the focus starts to come back to the United States, when things stabilize in Europe and Japan, and the focus starts to come back toward the United States, and let's say the Fed keeps hiking interest rates over the next 6 to 12 to 18 months to fight inflation domestically. And something breaks in the system, which happens every time they hike rates. This happened back in 2019, which is why they stopped hiking rates. This happened in 2007, which is why they stopped hiking rates. This happened in the year 2000, which is why they stopped hiking rates. Every time they try to hike rates in this kind of way, they end up breaking something in the financial system. And remember, they're fine breaking the backs, so to speak, of the working people. But it's when they end up breaking something within the favored financial institutions that they then pause, and actually not only pause, but they reverse their strategy. And instead of hiking, they start cutting. And that's when the precious metals tend to take a focus, the foremost focus around the world. It's when the psychology of the market comes back away from the problems in Europe, away from the problems in Japan, and says, wait a minute, the Federal Reserve in the United States just had to reverse its policy. They were trying to hike. They couldn't do it. Boom. Buy gold because the dollar itself is not safe. The issue is, and I've just shown you the evidence, that time appears to not be quite yet. Not quite yet. Because the dollar is breaking upward at this moment. And we should use this information to make sure that we follow these markets and do not get clobbered. Because that fundamental belief can be right, but you can still lose most of your hard-earned money if you do not follow the actual charts. Thank you for being here, guys. I think this is a really important video. I want to encourage you to learn about the founding of the Federal Reserve, but remember, as important as that is, it's only 50% of the equation. If you're not following the charts with us, you will be clobbered one day, sooner or later, by these markets. If you would like to follow this with us, not every couple weeks, not just talking about the currencies, but talking about gold, silver, the US dollar, as we just looked at, but also the US stock market, the rest of the commodity complex, as well as the gold and silver mining sector, which are leveraged to the prices of the metals. Remember, I talked about in 2008, in that crash, a lot of the miners fell by 80 to 90%. But in a rising metals environment, a lot of these miners can rise by 1,000%. So it's a high reward, high risk proposition. To follow along with us, exactly what we are doing every week, 50 weeks per year, make sure to check out Precious Metals Intelligence on the iGold Advisor website. We publish members-only videos like you're seeing right now. As I said, we cover much more than you're seeing here just in these videos. And you also get flash updates going right to your email inbox whenever we issue a buy or sell decision or anything impacts the markets that you should be aware of. If you would like to join us in the service that offers the most upside to the commodities sector, not just precious metals, but we are looking at other commodity producers as well. The service for you is called Elite Private Placements. This is a service where we receive free warrants with each investment that we are making, which gets you nearly twice the amount of the upside compared to open market buy signals when these stocks move higher. Remember, this is a very cyclical sector. You have inflation comes in, commodities move higher for a few years, then you get these waves of deflation. They move lower for a few years. But if you are accumulating warrants here with us during these periods of time, I am convinced that this sector is going to pay off multiple fold when you add the shares and the warrants together. Remember, this is called Elite Private Placements. We negotiate with these mining companies on your behalf so that you can participate in these highly leveraged private placements. This also includes a free subscription to our general investment service, Precious Metals Intelligence. If you would like to speak to me one-on-one, know that you can reach me on the Consultations tab. I do not take any fees or funds from any of the banks, any of the currency cross-pair vehicles, any of the ETFs, any of the bullion dealerships. I work directly with individuals such as you, so we can make sure that you are on a good path. And I simply tell you from my independent perspective what I would do in your situation. Make sure you have all of the research to back up the decisions that need to be made. Do not ignore those two charts. I just showed you the sum of the data for the euro versus the dollar and the Japanese yen versus the dollar. Dollars breaking out versus both of those currencies. As crazy as it might sound, even as the inflation here in the United States is the worst that it's been in 40 years. So I think what's coming ahead for the next several years is a series of waves where we're going to have waves of deflation when things are happening around the world, such as the war and whatever's happening in Japan. And you get these sell-offs across all asset classes, followed by waves of inflation. I don't think it's going to be a straight line in any one direction. Thank you for tuning in this week. Please take care of yourself. I wish you all the best, and I will see you for the next update soon.